All right, guys. Hope you had a great weekend and a great week last week as well. Crazy markets keep going up. Should be a busy week again this week too. More volatility ahead. For the economic data this week, we have ISM numbers on Monday. Tomorrow, Tuesday, we have vehicle sales. Wednesday, ADP employment report. That should be interesting to see. 8:15 on Wednesday morning. Also, ISM services index as well at 10 a.m. And then we have on Thursday, jobless claims, productivity, unit labor costs. And then Friday, we have the big numbers right here, non-farm payrolls. So that'll be interesting to watch. Also the unemployment rate as well. So keep an eye on those events for the week ahead. For earnings, we have a number of names still. We've passed most of the big guys, but tomorrow we have Hasbro before market open. We have Chegg after close, Take-Two Interactive, the video game maker of GTA 5, Simon Property Group, SPG, after hours as well. On Tuesday, before market open, we have Corsair, the maker of computer parts for gaming rigs, primarily. And then we have, after hours, Twtr and Cisco and Alteryx as well, right? Also Lyft and Akamai Technologies reporting after hours on Tuesday, so those big names too. Wednesday, prior to market open, we have General Motors, Coca-Cola, Under Armour. After close, we have Zynga, Uber, iRobot. iRobot's been very volatile due to being part of that GameStop, AMC, BlackBerry, Nokia kind of crew. Heavily shorted stock that's been very volatile of late as well. So keep an eye on them too. Thursday, before market open, we have PepsiCo, AstraZeneca, Kraft Heinz, Tyson Foods, Yeti. After close, we have Disney, which will be a big earning report. And then we have Aurora Cannabis as well, which should move the weed stocks as well, right? So keep an eye on the weed stocks for Thursday after close. Also Cloudflare, ticker symbol NET, right? Datadog, DDOG, Illumina Pharma as well, and JFrog too. Prior to market open on Friday, we have nothing really that important on Friday, I guess, right? So those are the primary Friday ones. So I want to look at a few tickers this week, starting off with Disney. So Disney has made a nice move off that that bounce right here off the 160 line. It's now trading at 183.55, right at all-time highs. And they report on Thursday, so expect a pretty nice move to the upside if they have a solid report, which they should, given that their Disney Plus subscription service has been killing it. So looking at the options chain, I'm going to pull it up right now, one sec. Here we go. We can see that for the week ahead right now, the expected move on Disney is 5% in either direction. Upside is 190.16, downside 172.16. The potential move this week on Disney is 7.2%, or an upside of 194.12, downside of 168.20. So given that thesis, or given those parameters, it isn't a terrible idea to look at perhaps a bullish strategy given where it's sitting on the chart, because it is looking pretty bullish right here. Upside I mentioned for potential area was 194 and change. So a 185, 190 call spread in this instance doesn't look too bad overall, right? You're paying pretty much $1.40 or so, $1.42 or so, midpoint, for a maximum profit of around 350, right? So you have about 2.33 to 1 risk reward, right? Which is pretty nice. Max profit over 190, break even at 185 plus 150 or so. So you have break even of around 186.50. If you want to widen that a bit and give yourself a bit more margin, obviously you can do that and go 185, 195 if you want, for example, right? And in this case, you'd have risk of $2.30 to make a maximum profit of $7.70. So you have about 4 to 1 risk reward, which is pretty damn good, right? Obviously, max profit is above 195. That's above the upper potential move, so we'd have to have a pretty strong run to get there. You probably want to wait till right before the event if you are going to play it, or if you do play it prior to the event, you may want to close it out prior to the earning event on Thursday after market close. And obviously keep in mind that binary events, if you're trading the same expiration week, it's pretty binary. Either you're going to lose all your money or you're going to make, some money on the trade, right? There's usually no middle ground there, right? So keep that in mind, manage risk accordingly, obviously. If you're bearish on it, you can play the opposite strategy, pretty much a 185, 180. Let me see. 1 second, actually. Let me just see the chart again. So it closed at 181.16 on Friday. So after hours, it actually jumped to 183.55. So this price will be a bit higher tomorrow at open if it's trading at 183.55 at open. That being said, if you go with the at the money put spread instead, 180, for example, 175, you're getting about 1.5 to 1 risk reward. Not so favorable overall. I prefer to play earnings after the event itself. So after they report, implied volatility will decline because right now it's 38%. Historical is 30%. You can see it's pretty damn high right now on the IV. So it might be a better idea to maybe even wait until after Disney reports on Thursday, see what happens on Friday morning. If they open flat, for example, then maybe trade directionally based on the report if it's a bullish or bearish report. But keep in mind, they are pretty high right now as well. The chart is looking very bullish as they are at all-time highs. So they could keep on running perhaps to around $200 in the next few months, right? But obviously, trading prior to the report is purely speculative, and you need to be okay with taking a loss if it goes against you, right? The alternative to that is trading the high IV itself and doing iron condor if you want to be neutral on the position. So, for example, we know that the lower area on Disney is supposed to be around 168, and the upper area is 194. So if we go, for example, down to 165, again, the risk reward here won't be that great overall, but the probability of profit will be very high. If you go down to, for example, let me just see here, perhaps 170, 165, and then you go to 195, 200. You can see here you're pulling at a credit of about $1.10 or so, and your maximum risk is 390. And you achieve maximum profit if Disney lands between 195 and 170 on Friday at expiration, right? So you have a nice big $25 profit window, about $12.50 or so in either direction, up or down. That's your buffer right there, right? And the probability of profit on this trade is around 90%, that it expires between 195 and 170. But that's why you manage your risk well, and if it doesn't go against you, you can adjust your position, obviously. So an iron condor here might not be a bad idea. Ideally, you open it up right before earnings, and because they report earnings on Thursday before market close, after market close, basically you have 1 day until expiration on the contracts, which is just the Friday, right? So, for example, if it opens up or if it closes at 185 on Friday or so, you want to look at the expected move up or down for the following day, and then go outside that range for your iron condor. And obviously, at that point, your maximum profit is your credit received. Maximum loss is the spread width minus credit received, right? So that's for Disney. The second idea that I had that I want to discuss was, and again, for earnings, staying on the same theme here, is for Corsair, right? CRSR. So they report earnings on Tuesday before market open, right? The chart is over here. As you can see, they've had a very, very nice channel over here, moderately higher lows over here, and moderately higher highs, aside from that big burst over here they had back in November. But you can see that they're pretty much following this trend line over here on the downside. So whenever it touches this area, it bounces back up again. And now they're pretty much trading in this channel on the upside, like right around over here or so, right? If they have a great report, which they should, given that a lot of people are building new gaming rigs, and people are staying home, obviously, and spending money online in this fashion instead, they could have a pretty solid report, and that would take them to new all-time highs probably, right? Again, I mentioned the upper expected move on them is for the week ahead is 17. Sorry, the expected move this week is 17.8%. So the upper expected move is $53.28. Lower expected move is 37.18. And then you have the potential move, which is 24.6%, upside of 56.39. downside of 34.07, right? So again, looking at this chart right here, it looks pretty bullish, but it has to break above the all-time high over here, and then at that point it can just run to whatever it wants to run to. It can run to perhaps, you know, even $60 possibly, right? But looking at the option chain over here, where is it? Here's the option chain right here, right? So Corsair. So we can see that, again, trading spreads is a good idea because the implied volatility is high, higher than the historical. And again, earnings are a risky event to trade. But that being said, if you want to take a risk and trade it, that's your decision. Keep in mind, they only offer monthly OPEX. They don't offer every week. So that's an issue right there. You need to trade for next week, not for this week, which is actually not too bad because it actually lowers your risk a little bit because you have more time to adjust your position if you want to. That being said, if you want to go longer term, you want to go March or perhaps even May. But looking at the position right now, you can do, for example, on bull side, and again, this is just an idea here, do your own homework, manage your own risk, make your own decisions, right? But on the bull side here, you could do a 45-55 call spread. That's an at the money call spread, 10 wide. You're risking about $2, about $3 or so for maximum $7 profit, right? Break even's 48, maximum profits above 55, right? So right around that upper potential move for the week, right? On the downside, because the skew is favoring the calls right now, as you can see, the put to call interest is 0.64, meaning that there are pretty much 2 calls being bought for every put that's being bought right now. So on the put side, you can do a similar strategy if you wanted to out of the money, but obviously the asymmetry of risk will be a little bit different, and you're going out of the money here by $5. You're risking about $2 or so to make about $8. So 4-to-1 risk reward, break even is at 38, right? For next Friday. So this is 2 weeks out, not for this Friday itself. Corsair is interesting because someone actually posted a report on Reddit, and they posted pretty much that that Corsair was going to beat their earnings report based upon numbers they published online already. So it's likely that they beat earnings. Who knows if they actually pop up, if it's priced in or not. But here are some ideas to just take into account if you want to trade Corsair. I would keep an eye on it, and again, I'm probably going to wait until after earnings itself and trade it after the event, because after the event, IV will decline. My hope is that they have a massive beat and a flat to negative reaction in the market, at which point I can go longer term with some call options or even buy the stock and sell covered calls against it, perhaps, right? That's my intention, right? If you want to be more conservative, you can always buy the equity itself at around 45 and change. And if you wanted to, you could sell the 50 strike covered call against it, at which point you're making you're reducing your cost basis from 45 down to around 42, right? So you have upside of $8 in 2 weeks. Risk is 42 to make 8. So 8 over 42 is a return of 19.04% in about 2 weeks, right? And obviously you need to be okay with owning the stock at 42, right, itself. So that's Corsair right there. The other name I wanted to mention was Twtr, right? So Twtr reports this week as well. They report again on when was it? On Tuesday after market close, right? So Twtr is over here. One sec. Twtr. Here's the chart. As you can see, over the past year, it's pretty much traded higher lows. So so again, from the March low, low over here, right? Low over here, low over here, low over here, higher lows, right? And likewise, higher highs, right? Higher highs across the board. So looking very bullish overall again. And last week, Pinterest beat their earning report. Also, Google beat as well. Facebook reported the week prior. They had a decent report. Obviously, they're concerned about the Aapl changes to their OS terms of service agreement for tracking people, right? But Twitter's a bit different in that respect. So looking at Twtr right now, again, a lot of bullish formations here because the market's trading at all-time highs. So keep that in mind as well. But looking at Twtr for the week ahead, the expected move on Twtr is 11.9%. So upside is 63.53. That would be a new all-time high. Downside is $50.03, right? The potential move for the week ahead is 15.7%, upside 65.72, downside 47.84, right? So downside is right over here. Upside is, off the chart pretty much, right? Again, similar ideas can be used on Twitter. Because the IV is very high, you have to use spreads if you are going to trade it. Because again, IV here is 74.9%, historical is 52.7%. So you have a big deviation here. If you do buy just calls or puts and you are correct even in your directional movement, you may get IV crushed, and that IV will decline probably about 15% or so, at which point you're going to see your position diminish in value dramatically. So looking at some ideas here on playing Twitter, if you're bullish, obviously, you can go with the call spreads to the upside and trade perhaps, for example, the at the money, so 57.50, you go long here, right? And then out of the money by a few dollars. Again, they have weird increments above 60 because I guess it hasn't traded there yet. And you have less liquidity over here. So spreads are a bit wider as you go out of the money here. But for example, if you wanted, a lower risk play, you could do, a 57.60 call spread here. It's not really that exciting. You're risking $1.10 or so to make a maximum profit of 190. So roughly 2-to-1 risk reward. Break even is 58.10. And again, you can play around with different strike prices and different numbers if you want to try, out of the money a bit. If you want to go in the money more, you can. If you want to go wider, you can. If you want to go narrow, you can. It's entirely up to you, right? There are an infinite number of permutations for strategy building in options, right? Possibly a better strategy may be to do iron condors again on Twitter, given the high IV. So looking at outside the expected moves or potential moves, you might look at, for example, 65, 70, right, on the call side. And then on the put side, you may look at, what was the lower move? The lower move was 48, right? So going below 48, not a lot of premium there really though. That's the only issue. So going down here, you're basically making 95 cents or so maximum credit for maximum risk of $4.05, right? Again, iron condors, you're never gonna have great asymmetry of risk. What you will have is a high probability of profit. In this case, probability of profit is around 85% approximately, right? Obviously, do your own homework, manage your risk accordingly, only use strategies you understand, and don't put money in you can't afford to lose. Remember that, okay? And obviously, everything I'm discussing again is purely for educational purposes only, right? Outside of that, we have two positions I like a lot right now, which are prime setups that I see. I like Aapl and AMD as great setups right now. So I'm going to pull up the charts on those names. Where's Aapl? So here's AMD first, right? So again, I mentioned it a few weeks in a row, but here's AMD's chart. And you can see that it's held, it's kind of like messy over here, but you can see that it's been holding this line of 85, which is the new range. If you notice, again, I mentioned this a few times over the past few months, that AMD is forming a higher and higher ranges, right? So if you pull up the 2-year chart, you can see, again, they're trading in this range between roughly 25 and 35. Then they broke up, right? Then they traded between 45 and 60 or so, right? Then they broke up again, and they haven't pulled back at all since that breakup over here. And they traded for a few months between 75 and 85. Now the new range is 85 to around 100, right? They had a great report a couple of weeks ago. They were at 95 or so, right over here. They fell down after that report. Again, you can see declining volume on the decline right here overall, right? Which likely marked a bottom in AMD. And the beautiful thing about AMD right now is that the implied volatility is so low. Here's the IV chart. I'm going to show you guys. I showed a bunch of guys in the group last week as well, right? But here's the implied volatility charted, right? And you can see that over the past 1-year period, if you're looking at the March expiration contracts, right, the implied volatility has not been lower in the entire past year, right? This means that buying calls or puts is very, very favorable overall because you're paying a low premium relative to the historical average, right? So in this case, you don't necessarily have to use spreads because your IV is already low, but it's not a bad idea to do so anyway to mitigate your risk. And there are some conservative strategies to be used, given that we know that the range right now is 85 to 95 or 100, right? On that thesis, that's going to go back to 95 or so. Looking at call spreads to mitigate your risk. Let me just pull up the option chain 1 sec. So I'm going to close this, or actually I'm going to change screen first. 1 sec. Here's the option chain. I'm going to close this again. And then also keep in mind for AMD, the expected move this week is 3.5%. So upside is 91, downside 84.80. So right around the support area. And the potential move is 92.22. Downside is 83.58.
Nick, we're still looking at Twtr.
Oh yeah. You know, I was just looking at the moves. Yeah. So AMD's over here, right? Looking at the moves over here, right? So again, you're going to want to go out and give it more time to marinate and actually, you know, have time for the trade idea to transpire, or the trade thesis to transpire, right? It's not a shorter term trade. I would go at least a month. But again, do your own homework, make your own decisions, right? I like the $80 call options in the money, right? Because you're paying low extrinsic value, right? You're paying pretty much about $2 or so of extrinsic value overall. And then if you go with a short contract at around the 95 strike, right? Now your overall debit goes down to about $7 or so, right? That means your break-even point is 80 plus 7, 87 bucks, right? That's lower than the current price it's trading at, and you have upside to 95 over the next 40 days, right? Your maximum profit is about $8. Your maximum loss would be $7, and obviously your break-even is 87. Maximum profit's over 95. The nice thing about this is that if it goes to 95 prior to expiration, at that point in time, you can then turn the strategy into a combo spread. So you could sell a credit spread against your debit spread. So for example, let's say it went to 95 next week, and your position is now worth 11 or 12 bucks, but you still have 40 days till expiration or so, or over a month till expiration. At that point, you could then choose to sell, for example, the 100 115 call spread, right? And that would be trading probably around $3 or $4, right? Which means that you would reduce your debit down from the debit of 7 initially down to about $4 or $3, which means that your break-even price would go down to about 84 or even 83, and your upside would then go from $8 up to about $11 or so, right? Or even $12, right? So that's a way that you can adjust your position if it was in the money too early, instead of closing it out and taking profits too soon, because again, it won't trade at maximum profit unless either A, it goes deep in the money, I'm talking like 10 bucks in the money prior to expiration, or B, until expiration itself, right? Because even if it was for Friday, for example, this trade, it would be trading at still, let's say it was 95 bucks, it would only be trading at about maybe $13 or so maximum of your maximum profit. You still have two bucks left to get. So the idea is that if it goes up too fast prior to expiration, instead of closing out early, you sell a call spread against it above the upper range, which is again I mentioned $100 is the upper range right now, right? So you'd sell the $100 strike and then buy the 115, which is an equivalent with spread against your long spread here, right? That would reduce your debit down overall and increase your profit potential in the trade. And then maximum profit would be found between 95 and 100, right? That's a decent idea right there, right? I think AMD is a solid long-term position to be holding right now. Obviously, do your own research and make your own decisions for yourself. But right now, their forward price to earnings ratio is only 35, which is pretty damn impressive. Just for comparison's sake, looking at some of their peers right now, like for example, if you look at Qualcomm, right? They're at 17.84%. They're a more established company, obviously, but AMD is growing revenues dramatically, right? Like right now. So year over year, 2019, they did revenue of $6.7 billion. 2020 revenue was $9.7 billion, right? Thus far, in the past 12 months, they've done 9.76 again. So we don't have the full data set there, but they are growing revenues at a pretty fast clip for a large company. And that's making them much more attractive overall. They got a bunch of upgrades as well last week, or sorry, in the past couple of weeks to 110 or 120 price target overall. The average analyst price target, not that it means much. Again, I don't really take too much weight or put too much weight into the analyst targets is 102.37. That's the average price target right now on an AMD, right? And they're trading at a price to sales ratio of 10.82, which is not too bad either, right? So that's AMD. I want to discuss Aapl as well, because Aapl had a phenomenal quarter last report as well, and yet they've traded lower since that report. So I'm going to pull the chart here so you guys can see it, right? Here's a chart for Aapl, right? They were at 144.30 prior to their earnings report. They fell down to around 130 or so, and they've since bounced to 136.68, right? Now, there's a lot of discussion around the Aapl car and who they're going to partner with to make the Aapl car, which is still a few years out. But I do believe that we're going to see some more upside over the next few months. This is a longer-term trade, or a longer-term investment, not a trade, right? I think that Aapl will trade around 155 to even as high as maybe 170 or so by the end of this year, right? Again, obviously, that's contingent on no market crashes in which we do not correct back to the upside, right? I am expecting a pullback in the markets still of about 10% or so by mid-March, but at the same time, I am very bullish on big tech because big tech has not really participated in the rally as much as other stocks have as well, right? So like Aapl, for example, hasn't really moved up too much. You saw it hit all-time highs back in September of last year, 138, and we're still below that number right now, even though they had a phenomenal quarter, right? So keep that in mind as well, right? We have a fair amount of upside, I believe, in Aapl, and even in for example, Microsoft, right? So you can see Microsoft as well, right? They hit all-time highs previously in September again, around 233 or so. They're only at 243 after, again, a phenomenal quarter again, right? So I think we're going to see a fair amount of money pouring into the Fangman stocks, Facebook, maybe not Facebook, but Amazon, Netflix, Google, Microsoft, and Aapl as well, right? And NVIDIA as well, right? So looking at Microsoft, pretty bullish over here. Salesforce hasn't reported yet, but they're curling back up here. They filled the gap over here, and it is possible. Actually, I would say it's probable that you see it push up toward around 280 again by the end of this year, which means that you have at least probably $40 upside on the stock itself. So 40 over 238. You have upside of around 17% on the equity itself this year, right? In the remaining roughly 10 and a half months we have left in the year, right? So I like big tech right now because again, it's very resilient, and it's shown that in the worst economic climate we've experienced pretty much ever, that they can make boatloads of money, right? Apple's doing phenomenally well. Microsoft, Amazon, right? Amazon did over 100 billion in revenues last quarter. Same with Apple as well, right? Google, phenomenal quarter too. Facebook, I'm not very hot on because again, if Apple blocks them from tracking people on iPhones, on iOS, that will be a big problem for them. And they actually mentioned that in their conference call a few weeks ago as well, right? So keep that in mind too. Facebook, I'm not so hot on. But looking at Aapl, let me pull up the option chain again for Aapl, right? Here's Aapl right here. So playing it longer term, the better way to do it probably for most people here, because a lot of people here or whoever here is new to option trading, focus on longer term first, understand the ropes, and then as you learn more about options, then try your hand at shorter term trades. Because again, longer term means you're going to have a higher probability of profit, because at some point between today and your expiration date, 1 year from now, there should be a point in time at which you're profitable, right? That means you have a window in which to take a profit if you want to, right? But in the case of Aapl here, I think that buying a synthetic position, wherein, for example, if you want to buy the stock right now, and keep in mind each option contract covers 100 shares of stock, right? So when you're buying a contract, a call option here, and you're paying $30 for it, for example, that's 30 times 100. That's $3,000, right? If you want to buy 100 shares of stock right now, you're paying $13,668 approximately, right? So let's say, for example, you want to go long on Aapl for a year out. You can buy for example, 110 strike or even the $100 strike call option if you wanted to, right? And that means your break even is 100 plus, let's say 42 for argument's sake. So you're paying $4,200 for the right to buy Aapl at $100 1 year from now, right? And effectively your break even is 142, which is about $6 or so above the current price. So you're paying about $6 of extrinsic value. And you might say, why would I do that? Well, instead of paying 13.5 grand for 100 shares of Apple stock, you're paying $4,200 for almost the equivalent position in Apple stock. And then what you could do if you're trading in a margin account is then sell some premium against your position above your break even. Again, your break even is 142. So look, for example, at maybe the 150 strike for a month out or so, right? Sell over here, right? Now what happens is that your debit goes down to about $40. So your break even is now 140, and you still have upside of $10 over the next month or so, which means that if you achieve max profit, if you hit 150 on Apple in the next month, then you're making $10 profit on your position. That's a return of 25% in 1 month, which is a great return for most people, right? Keep that in mind, right? So just an idea right over here. Additionally, if you want to make it a true position, a synthetic, what you could do as well is sell the put option as well. But I prefer to wait for a pullback in the stock to sell a put option, not when it's trading higher. And again, the IV right now is low, so selling options makes less sense, right? You're better off waiting for a pullback in which, for example, if the market corrects, let's say 10% in the next month and a half or so, and Apple pulls back to like 125, and IV goes to like 45 or 50%, in that case, then put some more expensive. At that point in time, sell a cash secured put, right? So Apple, I think, is a very, very strong long-term play because they have so many fingers in different pies, right? They have their fitness subscription revenue. They have Apple TV Plus. They have Apple Music. They have iCloud. They have the AirPods Max now. They have the AirPods Pro. They have the iPhone, different varietals as well. They're going to have the Apple Car eventually. They're doing Apple VR goggles apparently as well. They have MacBook Pros. They have MacBooks. They have MacBook Air. Like they have so many product lines right now. It's kind of crazy how much they've got going on, and they are doing phenomenally well. Even in the worst climate economically we've ever experienced, they are selling crazy amounts of phones and AirPods that are $1,000 basically in Canada or $600 in the US, which is insane, right? That means that people, even if they're broke, they're buying Apple products. So Apple is where you want to put your money longer term, right? Again, obviously manage your own risk, do your own homework, do whatever you're comfortable with. Don't take my word for it. Do your own research, right? I'm just sharing my ideas here, guys, right? So for Apple, for the week ahead anyway, if you want to look at short-term positions instead, the expected move this week is 2.4%. Upper move is 140, lower move is 133, and then the potential move is 3.4%. Upper move 140, 144, lower move 132.08. And again, thank you very much to Frankie for posting these expected and potential moves as well. I appreciate that, Frank, as well. Now looking at the indices here, I'm actually going to look at maybe a few more tickers, and then we'll call it quits and maybe do some Q&A before we break off. But looking at the indices here, so namely SPY, and also here's SPY's chart right here, right? So the reason why I think we're due for a pullback again, and I mentioned it a few times, is that we haven't had a substantial pullback in quite some time. Even this pullback we had a couple of weeks ago, on the GameStop fiasco, where everyone was worried about, the market was going to crash because of GameStop. We only pulled back about, I think it was about 4% or so, right? It was about 4%. If I zoom in more, I can see it better. One sec. So you can see that the actual decline was from the top over here to the bottom over here, only about 4.4% or so, right? Maybe a little bit more than that. You get the idea anyway, right? But the point being here is that we haven't really had a substantial correction in the past, basically since end of October, right? You can see that since October the 30th, we've pretty much run nonstop. And if I draw a line from the bottom over here to where we are right now, the broad markets are up 21%, or sorry, yeah, 21% or so in the last 3.5 months, which is pretty insane, right? Or sorry, 4.5 months. Sorry, no, November, December, January, yeah. So 3.5 months, right? That's pretty insane. Looking at the Russell, which is actually even more insane, given that it's full of crap companies, this is pretty crazy right here. You're seeing an index full of crap companies with negative earnings overall in the entire index. Look at this. It's up 47% since end of October here, right? At some point in time, logic will prevail, and this will come down heavily. Who knows when that'll happen, but keep this in mind, because at some point in time, this will come down very heavily, right? An index full of dog crap companies should not be trading up 47% in 3 months and change, right? The NASDAQ over here, here's the QQQ ETF, right? You can see that it hasn't performed as robustly as S&P or as the Russell, right? But it's still up a fair bit. And the larger cap companies or the mega cap companies like Apple, Amazon, Microsoft, Netflix, Nvidia, they haven't really done much overall, as I showed previously, right? Again, they're not at all-time highs right now, and they have room to run now. So my thesis is that you're going to see a lot of money pouring into those companies and out of the crappier quality companies, right? So just some ideas over here. I wanted to look at Nio as well before we go, because someone requested Nio. So just pulling up the chart over here. Again, it's now trading in a new range between 55 and 65. And looking at the moves for the week ahead on Nio, let me see if I can find them over here. We don't have them on the chart, but I'll just price them out fast. So 1 sec. So if I move over to the option chain here, we can see. So for the week ahead, we have an expected move of around $4 in one direction. So upside of 61, downside of 53. But again, I think that 55 area is going to hold pretty strong right now, barring a nice market correction, right? So trading the upside on Nio, I would wait for a touch point of around 55 area before going long. And again, we're not very far from that. We're only about $1.80 from that point. So just if you just set an alert on your chart, like for example, you pull up your chart, right? And you just, this is what I actually do, right? I just put an alert in. I'll just put it in for 55, for example, right? I won't even watch it. I'll put in an alert. I'll say, okay, if it's 55, alert me, activate, and then it's there. If it hits it, if I'm trading and I'm watching my, different charts, all of a sudden it hits, I see right away that it hits, and I say, okay, now I can look at going long Nio perhaps, right? That's how you should be using this information of the EMs and PMs to alert yourself to look at possible bullish or bearish strategies off of pivot points, right? Or support and resistance areas, right? But yeah, that's pretty much it for now. I guess we'll break off and do some Q&A. If you enjoyed the video at all, please like and subscribe, share with someone you think will find value in it. And otherwise, yeah, actually, one last thing before we break off, Virgin Galactic, I've mentioned this for the past few months that it was going to break out in a big way. And sure enough, it had a massive week. It hit upper area of 6250. And they have a catalyst event next Saturday, which is their new test flight, right? So again, I think that they've run pretty hard. They've already gone up from 2250 or so back on January 5th, right? Up to a high of 6250. So they're up about 182% or so at the high right there, right? So I think it's pretty hot right now, and it does have the potential to pull back in a pretty rapid fashion. I would say right around the 35 again area, maybe even the previous high of 4250. Also, the IV is very high right now on Virgin Galactic. So if you are trading it, just be very cognizant of the risks associated with trading it right now, because it's already run so heavily. My belief is that we're going to see a Southern News event no matter what happens with their test flight next Saturday, right? So keep that in mind as well. If you want to know the EM and PM for next week, the expected move this week is 14.2%, upside 62, downside 46.61, and the potential move is 64.94 upside, downside 43.74. I guess I'll cut the recording now and we'll do some Q&A. But again, if you enjoyed the video, please like, subscribe, post a comment if you have any questions, and share with someone that you think will find value in it. Appreciate it a lot. And we're going to cut the recording right about now.